What happened to another day, another dollar? Well, I don't know. All right, why are you joining us? Because, well, this could very well be either Wednesday, the accelerant, the fire on the gas, the gasoline on the fire, the type of run that just takes us to all-time highs, or this is going to be the ultimate sell the news event. There's no middle ground on this. Federal Reserve will be cutting rates most likely on Wednesday by 25 basis points. We will be looking at the forward guidance, and I'm going to walk you through the trade that you need to know when Jerome Powell puts on his purple tie and gets out there. But today we'll talk about screens. We'll talk about where smart money is positioning. We've moved to overbought on some areas of the market, which is a little interesting. And we're coming off that huge squeeze that started on November 21st when the Federal Reserve did nothing but, again, the Fed eliminating quantitative tightening on December 1st. In addition, we'll add about $20 billion a month in short-term bill purchases to help stabilize the financial markets. This is not known as quantitative easing, but the thing that matters is the fact that it is aimed to achieve the same outcomes that quantitative easing provides, which is stability. Financial stability. So there's a floor to the market. And then, of course, Japan adding $117 billion in stimulus. Hey, don't tell me it's not about liquidity. Don't try to convince me of anything else. All right, momentum is in the green. We're green on the Russell. We're green on the S&P 500. We're green on the NASDAQ. Hey, so what is this reading, by the way? It's liquidity. Let's just cut the brakes at this point and let you know every time that this goes red, it is largely a reflection of liquidity questions in the broader market. This goes all the way back to COVID, February 21st, 2020, the first time that we ever had our signal go negative. And it's really a measurement of understanding what is going to be impacting the S&P 500, what's going to be impacting all of those companies that are extraordinarily weak because they have no profitability. What, 800 companies on the Russell 2000 have no profits? Well, interestingly enough, we just came through, this is not that shocking to be honest, but the last 2 weeks of the markets were the strongest short squeeze since August of 2022. I want you to just put this into perspective, okay? All the Russell coming back, it was largely, again, a ton of those names, a ton of those companies that don't have any profits. We were oversold. We squeezed up. We're moving toward all-time highs again on the Russell 2000. It is not earnings. It is not profitability that is driving this. This is a liquidity issue. Money has to go somewhere. So here we sit, waiting for the Fed to make their announcement on Wednesday. I highly encourage you to be very, very active over the next 48 hours. If you made very sizable profits in the last 2 weeks, do not be ashamed to take profits or sell calls on top of existing positions, because at the end of the day, the general sentiment right now with the way that the market has moved is based on the idea that, hey, the point of the market is to sell. And if we roll over, it is potentially a reflection of the fact that the Fed's not going to cut by 50 basis points. We already know they're likely to cut by 25 basis points. So that's a sell the news type of event. We are 19 on the intraday reading. We continue to see strength. We continue to see movement on those companies in the Magnificent Seven. The MAGS, MAGS, is back above its key moving averages. Once again, showcasing that leverage is back in this market after that short-term panic that we've seen. And we've had a couple of these sell-offs this year. They've been very, very short. We've bounced off of a key resistance or a key support level. Either it's the 50-day, 20-day EMA on the MAGS, or the 50, which is the blue line, or in the most recent case, the 100, which signals that the next time we test that 100-day, we're probably going to test at some point that 200-day moving average, and that's a lot lower than where we are right now. All right, so let's dig into what's happening this week. Futures are stalling, of course, ahead of the Fed decision. And the thing about this is that there's a lot of traders out there who will just say, I'm not doing anything for the next 48 hours. I'm going to wait for the Fed to step in. That's actually the wrong behavior, because what's going to happen in the next 48 hours is that institutions are going to start to position themselves for that 2:30 announcement on Wednesday. That can lead to pretty wild swings in prices. And it might not be in the traditional places that you're looking. It might be, of course, in the fact that you're looking, potentially at names of the Magnificent Seven and NVIDIA and all those other names. But don't be shocked and don't be afraid to take a step back and look a little bit deeper and consider the fact that, yes, you have opportunities that are emerging. You have to look maybe in the quality names. You may need to look some other places. So we're going to be walking you through all that stuff each day over the next 48 hours, Monday and Tuesday, and we will continue to look for opportunities as they emerge. 1 second. All right. Next up, dollar softens into the Fed week. U.S. dollar pulling back ahead of the Fed meeting. This is not shocking. The U.S. dollar had been very strong. We look at the UUP as our key gauge. If you're looking for weakness in the dollar, remember the UDN is in play. The UUP has dropped. We bounced right off that 50-day EMA. And on top of that, as we look through this broader market, key thing here is if you're looking to ride the weakness, watch UDN. If the UDN breaks and remains above that 8-day EMA, where it currently is by a penny, you can buy in-the-money calls heading out maybe a week or 2 weeks, looking toward that $19 level. But instead of speculating up here, what you could do is buy in-the-money on the $18 call. And that is going to cost you probably somewhere around 60 to 65 cents. It's nice because you don't have to really do much. You don't have to buy 100 shares for $1,859. Instead, what you could do is buy and hold effectively the same position, 100 shares using leverage with options for roughly 60 to 65. Probably going to be somewhere in the 62 to 63 range, but we're going to look for continued weakness in the dollar through the Fed meeting and onward. A weak dollar boosts commodities and emerging market assets. It supports multinational earnings. Any hawkish pivots could snap FX flows back. Watching the DXY, the euro to the U.S. dollar, and the Aussie to the U.S. dollar. In addition, gold is back in play. We've been all over HYMC. We've been selling put spreads on that, and we did the same with Newmont Mining last week. Gold has extended its gains thanks in part to that softer U.S. dollar. Silver, platinum, palladium also pushing higher, and traders are hedging ahead of that policy uncertainty that is coming up this week. Gold is basically showcasing some sort of macro caution. There has been warnings, of course, saying that there is a bubble in this. I'll mention this in a moment, talking about the Bank for International Settlements. But for the most part, the question is gold in a bubble or are we in a paradigm shift? And I'm going to walk you through what all of that means over the next few minutes. A move in metals often leads to broader risk sentiment, and rising gold implies demand for protection in an environment where we continue to see these major breakdowns. Gold has moved very, very strongly since it hit about 2,500 last summer. We were long gold at 2,100. Silver, we were long at 25. Silver now pushing toward that $60 level, and there is much more upside available if the physical market continues to show strain. GDX is good, rising yield, spot gold. Remember, the PHYS is the physical Sprott ETF. We've talked about this before. It's a closed-end fund, forgive me. The Gold Trust. This has been a very solid way to own physical gold without actually having to take delivery. It is tied to the underlying assets of what Sprott owns in Canada. In addition, you might want to look at the GDX and the GDXU. The GDX, as we've noted, 81. Effectively, what we look to do is sell spreads down below where we were on recent lows. That puts us at about 70. You can look out into January or February, sell the $70 put on the GDX and buy something like the 67.50. You're looking for an 80% probability of profit, around a 15 to 20% return, and an annualized return somewhere in the range of 100%. All right. Last thing here that I do want to point out. This is from the Bank for International Settlements. Now, I read what the Bank for International Settlements does and says so that you don't have to. And if you want to send me a holiday card for that, I would greatly appreciate it, because this stuff puts you to sleep. The Bank for International Settlements is basically the central bank for other central banks. And they matter because they're the ones who are basically doing the research showcasing the problems in the broader financial system. For example, they were the ones in April that put a report out that basically said the United States Federal Reserve cannot do anything without impacting other economies around the world. They basically said the same thing about Japan doing things that impact the United States and Europe. Basically, the Fed, before they want to do anything, they have to basically check in with Tokyo and Brussels and Frankfurt and London and Ottawa. And the reason is this: if they raise interest rates too much, it can pulverize another economy where those nations are raising interest rates to keep up with the United States. Why does that matter? Because we had a massive financial crisis in 2022 in England. It was known as the gilt crisis. As those interest rates rose, it impacted the underlying value of the bonds that the pension system owned. And resultantly, if funds had to sell those assets, they were losing lots and lots of money, and they were trying to raise cash at the same time. What ultimately happened, the Bank of England had to step in and pivot and provide stimulus. Oddly enough, Japan just did the same thing. Here's what the Bank for International Settlements is saying right now about U.S. equities and gold. Bubble-like behavior for heavy retail flows. Gold is up 60% this year. AI tech stocks are extremely stretched, and retail options activity is surging. Now, keep in mind, retail options activity is surging because they continue to create products for retail options to people to speculate on. We're going to have zero date on NVIDIA and Apple and Amazon and Tesla 3 times a week. So they're doing it. But that said, gold's up 60%, not this year. That's not right. Last 2 years, forgive me. Let's just say gold up. Old deck. All right. Gold's up, massive level this year. But here's the thing. The reason that this matters is there still are issues with supply, actual supply of gold and silver. So this type of warning from the Bank for International Settlements that will spill down into other central banks could just simply be, hey, can we try to get everybody to stop buying too much gold because there's not enough supply? That's an issue in silver right now. Well, here's the thing. Excess retail concentration raises reversal risk in gold, absolutely. And if you are in gold, what do you do? What do you focus on? Well, again, it's all about momentum. And remember, every single thing that we are focusing on is built around technicals. When things break under 20-day EMAs, 20-day moving averages, certain algos stop buying. When it breaks under 50-day moving averages, certain things just shut completely off. That 50-day and that 20-day are your clues to really understanding if something is going to start facing some stress. You have the MACD to help you measure flows as well, short duration. And as you're seeing, there is some compression between those timelines. You see the blue boxes. Those are a histogram of price. And what have we seen? When the MACD goes negative, when it flips, when that black line goes under that red line, that is selling. And where do you step back in? Well, you step back in at the combination of a break above a key moving average, something like the 50, and a positive switch on the MACD. Now, if we see selling, if we see a big sell-off in gold, I'm not predicting that. I'm just trying to react to what the market is doing. If we have a sell-off, where do you step back in and buy? Well, you want to be focusing on what the relative strength index and the money flow index tell you. The RSI is a price oscillator, 14-day price momentum indicator, and the MFI is a combination of price and volume. And what we're looking for is a period where something gets into oversold territory. Oversold on the RSI is 30 or less, MFI is 20. And when they both hit that level, that is where we hit oversold. That can be a reflection of price in gold being oversold. It can also just be the stocks that are linked to the miners. And that's where I want to step back in, maybe sell some puts or start to build my position. And on the same side of this, as you can see, overbought, 70 on the RSI, 70 to 80 on the MFI. Even in this environment, we have been overbought. We had a whole period of time in September, about 6 weeks, where the RSI was overbought. MFI was overbought as well. It just didn't go down. It just kept moving higher. So that's why it's important to keep in mind those key moving averages, watching the 8-day, watching the 20-day, watching the 50, and looking for these crossovers on something like the 8-day and the 20-day moving average for momentum breaking down, or the opportunity to step back in and look for a buying opportunity. All right, 9 o'clock, we got the runner. I think Brandon's joining me at 9:10. I don't know. I like surprise guests. Siri, Upstart, Team, BB. These are all crap. Sirius Holdings. I'm going to note this. Easiest way to trade Siri, sell puts. Just do it. Don't think about it. Look out maybe a month, month and a half, and just keep in mind that when it comes to a spread on Siri, this is a Warren Buffett stock. This is something that Berkshire Hathaway had been stepping in and buying on a pretty frequent basis. So Buffett in somewhere around like the 20 to 2050 level. What do I like to do? I like to go down further. I want to go down to like 18 if I can and look for an opportunity. I'm going to look out to the January 16th real quick. Not crazy about that option setup. I'll go out to February. There you go, Garrett. Good job. Good job, Garrett. Selling the 19, buying 17. If I can get the 19, if I can write that for about 44 cents, and I can buy the 17 somewhere in that 20 to 23 cent range, what that will give me is a spread. The spread would be pretty tight, but I'm just going to note it's not the most exciting trade in the world, but it's a trade. 88% probability of profit, 11.5% return. Putting up 179 to make 21. And what you're doing, once again, is you're selling a put here, and you're buying a put down here. As you can see, we would be below that April bottom. This is a good company. This is a name that just continues to get bought. It seems like it's an arbitrage play by Buffett. But going out to February, hey, to make 11% on a stock that I know that Buffett has defended around the $20 level, sure, absolutely. And I'm choosing February because February is a very boring time of the year. Not a lot going on. Valentine's Day, shortest month of the year. I don't know. Yeah. So kind of a quiet trade, but a double-digit trade looking out into February. That is the $19 put. The $19 put for February 20th, writing that and buying the 17. On top of that, we have Upstart, UPST. This is a momentum stock. Exciting. Very exciting. All right. Coming back off that bounce, off the sell-off, that bottom there on the 21st, in line with April. And as I've said before, when it comes to Western central banks, when Western central banks engage in stimulus, it's bullish for financials. It just is. So here you are on a $47 stock right now, and I just simply note this. This stock has bounced very, very strongly from that recent bottom. So if we look at this and we see, all right, well, this is down at 31. We had that recent push at about 35. It has done well when it gets back above these key moving averages, right? 820 on the EMA. Same thing here, 42. So what do? I think what's pretty easy to do in this environment, and what's nice about a trade like this, what I want to do with a stock like this, because there's a lot of uncertainty around it, I want to stay in the money. Now, here's the issue. The concern that I have with anything in the financial sector is obviously that we have this type of sell the news event that might be coming up. Now, this could be an accelerant for the market. We could see a nice, strong rally on the backside of whatever the Fed does, or it can go the other way. We don't know. And I am not in the business of prognostication. I know that people want the absolute truth. I am humble enough to tell you I have no idea what is going to happen on Wednesday. All I can do is react, which is why I'm going to walk you through the 235 trade at in about 5-10 minutes. But real quick, very important. If you're looking at this with a company like Upstart, you can go off of where we just were. We just came down to that $20, $30 level. You can either stay in the money, buying somewhere like the 40 and selling at the 45 level, because if it does pull back, okay, you've got a little bit of a buffer you can get out of the way, or you could sell spreads to the downside. And that's kind of it. All right. On top of that, BB. BlackBerry. This is still a company. Remember when this was like the best company and now it's not? Well, same thing here. All I'm doing here, I'm buying the stock at 433. Everything looks good. Momentum, RSI, MFI, MACD, ADX. Stock's up a penny. I'm buying the stock here and I'm setting a stop back at the 20-day. Yep, 7 cents. So that's going to put me really down at around that EMA 8, so 422. I'm buying for 433. I'm setting about a 2.5% stop. I know that sounds crazy, but the point here is I'm looking for a move back toward that $5 level. I don't want to lose any money. So I'm just going to set a very tight stop on these key resistance levels. If you want to protect yourself from the algos, maybe you set the stop back at like 410. But BB, that's what I'm buying today. Oh, no. It's always sad when a stock that I like hits the selling levels. But CGRY, great company. Great private equity partnership in the energy space. And I am going to stick with this company for the long term. That said, we're oversold, obviously, right here on the MFI, but the RSI has not done that. So another move down, potentially to the 980 level. If we get under 980, then we're clearly going to 940. Oil prices continuing to be pretty solid right now, despite the fact that OPEC is expanding its production. We go from there. LSCC is weak as well. And then you have Love, CFLT, and CoreWeave in focus this week as well. It's 9:10. Brandon, are you joining me?
You asked me to come on. You forgot me already, huh?
I forgot you already. I'm so sorry. Okay. Let's talk. All right. So you got the Fed coming up this week. What do you do over the next 48 hours to help you prepare for what could be the ultimate sell the news event or the accelerant, the gasoline on the fire?
Well, you spent some time talking about gold, for example, and what you saw last week. You know, the Ghost Print surveillance console. We're scanning for large option trades, and what you saw towards the end of the week, you saw some very large put option trades being put on in gold, GDX, for example, and silver. Stocks like Hecla. Why? They're hedging, right? We've had a pretty nice move in gold and silver. I mean, in Ghost Prints, we played GLD, we've played BTG. We closed out our gold spread because we got close to our 70%. We rolled BTG, our calls, because we're trying to lock in, trying to reduce risk ahead of this event. And kind of similar to what you're seeing happening in kind of the institutional side of the trade is that they're hedging, right? They're trying to reduce exposure. This is going to be a pretty big announcement. Again, if they go hawkish, it ain't going to be a good thing. We got this run because we pulled forward those interest rate expectations. What if we say we're one and we're not really sure whether next month we're going to cut? That could be an interesting dynamic plays out. So I think you're right. This could be a big move either direction. Could be a buy or sell the news, either dollar weakness because of their policy, or we start to see dollar strength if the market starts to turn down.
I'm going to go on a different tangent real quick because you just said something that I think is really important for traders to really understand. You said they were hedging when it came to the put options. Michael Burry just put out a kind of a screed on Substack the other day, effectively noting that journalists didn't understand how his positions against Palantir and the S&P 500 worked. The S&P 500, he had bought puts, and he effectively said this was not a $1.5 billion bet against something. This was a hedge using put options. So can you talk just a little bit about the difference between when you see put options being purchased, the difference between knowing when it is a bet against something or when it is a large institution that is engaging in hedging?
Well, I mean, at the end of the day, I mean, you see thousands of contracts being bought or tens of thousands of contracts being bought. It's likely a hedge every time. Now, its impact on the market doesn't matter, right? So again, you buy 10,000 put contracts, the market maker has to sell it. The market maker has to hedge by going short. So you create downside called gamma, right? It's the pressure that drives prices down. So hedges do drive price, but I just say it's hedging because what does it matter? It doesn't matter, but it is indicative of hedges where they're trying to reduce risk rather than necessarily going bearish. But if we start to see the slide, that's where the pressure comes in, right? So if gold starts to tip on the Fed news, those downside hedges create downside momentum in those assets. And so that's what's the important takeaway. Now, again, I say hedges because do I want to short gold? Absolutely not. Okay. So I'll kind of bring that out saying they are hedges. You might want to take profits because again, this is not a sure thing, but if we start to tip, those hedges really start to create downside pressure in and of themselves. And so we saw that again, if Michael Burry's put options are hedges on NVIDIA, we certainly saw that once NVIDIA started to tip, we saw that downside pressure, that downside gamma hurt it, right? Or drive it lower. So, but again, we'll see what happens. This is purely liquidity driven right now, right? Every time the Fed looks like they may not cut, we push forward December's cut to January, market comes in, we bring it back, market goes up. Gold's following those moves as the dollar shows strength and weakness intermittently.
Interesting little data set that came out the other day. We just had, and I just noted this, we just had the largest short squeeze period the last 2 weeks since August 2022. I know that you were on top of this. I know that you saw what was happening in the options. When did the evidence of that squeeze start to emerge for you since that bottom in November 21st?
You know, and I don't know how they quantify that because when you say short squeeze, it's like, right, are they squeezing all the stocks with high short interest? The reality is the squeeze this summer, if you look at the list of companies that have over 20% short interest, that number has shrunk a lot. I mean, there's a site called highshortinterest.com. That went from 2 pages. Now we're down to 1 page. Now, if we're talking about a short squeeze in terms of, you know, there's a modicum of short interest across the market generally, like maybe NVIDIA, like Apple, and we see those kind of companies just getting squeezed. So it's a matter of, because I read that, I'm like, okay, what are they tracking? So yes, we do see, you know, some of the smaller companies that aren't in the mega caps, right? So I think really when they're drawing that conclusion, they're drawing it from, yes, there's a level of shortness in the market, and we saw those shorts cover, but I'm not sure it was necessarily as profoundly in these names. Now, the top stock on that list, Hertz. I mean, there was some huge call activity over the last week. 2 big trades in Hertz, and again, but because you get a trade, you know, we got to start to push those levels. And I can't remember the level. I think it was $6 on Hertz. If we get to $6 or through $6, I mean, as long as that interest maintains, you could see a huge move in Hertz. But it was for last week and for this week.
Yeah, Hertz is currently sitting at $5, and it's under those key EMAs. But I mean, this is one of those names that you just wake up and you have one of these moves. You have one of these moves,
right?
So it's good to see that you've got some focus there. As far as the Fed goes, you know, I said that I was going to just kind of walk people through something real quick just this morning. And I think Don's having some technical issues, just so that everybody knows. So we might be changing up our schedule a little bit.
He's on his island.
He's on his island, man. It's the sun. It's coming for you. I just want to just note, when it comes to volume weighted average price, this is the way that I focus and trade around the Fed meeting. What I'm looking for, this is the VWAP. These are the deviation bands that we talk about. If there is an overreaction to any of the news from 2 o'clock on, I'm looking for the S&P 500 to move down into that third or fourth deviation band and look for a move up. I'm not looking for anything else. I'm not looking for a pop and a drop. I'm only positioning myself in case there is a sell-off and then a squeeze. Is there anything that you do during the Fed meeting that you're paying attention to, or do you try to position ahead of the Fed meeting?
Well, so my thing is that, I mean, a lot of times the market's moving into the Fed meeting. So like, hopefully you're positioned beforehand, right? And so you're just kind of maybe clipping stuff. So I like to take profits ahead of it if I can. But what I'm watching though is that, what does the Fed move? It moves the dollar. So, so certainly looking at gold, because from my perspective, gold is the dollar, very direct dollar, right? So the idea is gold is priced in dollars. So if gold goes up, the dollar's going down. If gold goes down, dollar's going up. Then I can look at bonds, because again, is the Fed set to maybe reinvest? Because when they buy bonds, those bonds mature. Do they reinvest them? Right? I mean, some indication that they may be inclined to buy more treasuries. So the idea is that, okay, what's happening in the bond space? Those also represent inflation expectations. If you get out towards like TLT, for example, TLT starts to sell off. It could be a result of maybe increased inflation expectations. So from my standpoint, it's like I like to be pre-positioned and have stuff, take profits if I can. Like we took gold profits last week. We rolled BTG to reduce exposure if the Fed comes out hawkish. And then just looking at, again, currencies, bonds, and then the stock market, right? To see, okay, is the market reacting positively or negatively? Now you got two different parts to this, because I believe he has a press conference at 30 minutes after. There's the initial reaction to the statement. Now, the statement may not give you as much, and it may not give you as much movement, but then all of a sudden, let's say, for example, the statement's not really leading people to think that they're going to cut in January. It's going to be the press conference. And then, okay, what's his posturing in that? Is he kind of just saying, or data dependent? So again, all that's going to play out. And then you have the initial reaction to today's news going into the end of the week, and the next week can entirely reverse. So I think you do have to be nimble, but I think you have to kind of respond to what's happening here. And if we see selling in the dollar, gold goes up, this may be that next wave higher for gold right now, because I'm expecting seasonally gold as well going into the end of the year and beginning of the next year. For the last 14 years, it's done this. So I'm looking for gold's leadership, meaning leading the S&P 500. Market goes up, gold should lead, my expectation. And if market goes down, gold should still outperform the S&P 500. Maybe it doesn't go up, but it doesn't go down as much.
All right, so it's December. That means that it is time to start thinking about 2026. We all have to come up with our prognostications of what's going to happen next year. Is there anything at the big level in the macro that you're really paying attention to heading into January and February?
Well, I mean, we have this kind of this coincidence of what? We have a weakening job market. I mean, if you saw layoffs this morning, I mean, again, layoffs are pretty big. And we have consumer credit that's peaked. I mean, you mentioned as far as retail traders this year, right? Retail trade, they took on the highest amount of margin to buy stock than they ever have, right? Yep. We had all-time highs going into September. So the question is, where's the money going to come from? Historically, incomes were required to drive stocks. We've really become a debt-based economy, which obviously the Trump administration is trying to reverse a bit. Debt is a big, big deal. How can we keep expanding that frontier of debt to drive equities and drive asset prices? That's the key. And that's why the Fed right now is looking to cut, because they're trying to provide that liquidity, because they want you to take on more debt too. So we have this debt creation machine that's up against the weakening economy. And then obviously we have some manufacturing kind of showing some green shoots in there. So there's creating some degree of confusion, but I think this year we're going to probably have some sort of it's an election year. I mean, is there going to be some sort of culmination, right? In terms of a realization? The realization usually comes after the market correction though. So as we hit January into February, that's usually where you can experience a sell-off. So I'm seeing how we kind of posture that first month. What leads? Small caps lead? Do technology lead? Or does gold outperform the S&P 500? Those are some key tells right off the bat that first month.
Very good. All right. So Want to thank you for joining me today, Brandon. Sorry
Yeah.
about the confusion. We got a little. We're doing too much.
It's okay. We're good.
We've got Don. I don't know if he's joining us or if Blake's going to be coming up, but we will we'll put that in the chat in a moment. Very festive background like that. Oh, I was going to ask you a question, Brandon. Oh well, I was going to ask if that was Joe Duncan in the background, but we're going to go from there. Thank you, Brandon, for joining us today. All right, everybody. So listen up real quick. Again, as always, this is going to be a very busy 2 weeks. So if you are not a member of TheoTrade, get in the room with us, name your price, and take advantage of all of the things we're doing this month, including I'm going to be most likely chained to the desk on Wednesday to go take everybody through the Fed meeting, obviously working diligently to help you manage that trade as well. And then as we get toward the end of the year, as we move into that final week, I will be going through all of my forecasts for 2026. I know that everybody else has opinions as well, but that final week, that quiet week after Christmas, that's really going to be a great opportunity to get in here to focus on 5 major stories, 5 major trades, 5 major themes for 2025. You got to be a member of TheoTrade to take part of it. I want to thank everybody for taking the time this morning to join us. As always, you could be doing a lot of things at 8:45 or 9:22, but we will be back in a little bit. I'm going to toss this over to our team, and we will go from there. I hope everybody has a great trading day. I will see you at 3 o'clock today. Take care.